Good afternoon. My name is Marie and welcome to Trader's Corner. Trader's Corner is here to bring together the brightest minds in the trading industry and have them present to you in a live multi-speaker event. Today, we have a great diversity of techniques, software, and trading strategies that will be presented. The valuable insight that will be shared today by our educators will appeal to both the novice and advanced traders alike. Let's get started. We have a great lineup today. Our first presenter today is a graduate of the University of Pennsylvania. He started his career as a mathematician, contracted by the U.S. Navy. His expertise was the optimization of software. Today, he's the owner, developer of Right Light Trading Software, one of the fastest growing systems of the Ninja Trader platform. It is my pleasure to introduce Mark Sachs of the Right Line Trading. Mark, welcome to Trader's Corner.
Hey, thank you, Marie. And that was a real.
You're welcome.
Thank you for that nice introduction.
You're
And
welcome. It's been a pleasure.
thank you. And thank you so much for giving me your time today, everybody. And I see we have a lot of people. I'm going to just start with this disclaimer that all signals and trading opportunities provided both orally, written, or electronically that are disclosed to visitors or subscribers are for educational and demonstration purposes only. Right Line Trading takes no responsibility for any participation by visitors or subscribers within futures or forex markets or stocks, nor for any profits or losses may be incurred. Participating in trading in the forex and futures markets does involve substantial risk, and it should be understood that a person can lose a substantial amount of money. Therefore, this type of trading is not for everybody. Careful consideration of your financial position should be made prior to trading. Do your own due diligence and consult a financial advisor. Right Line Trading is not a registered financial advisor and not a licensed commodity trading advisor. Now, what I would like to, I'm not going to go over my background. I'm going to read that already for you. And what I would like to do is move right down to our assessment of order flow. I'm going to show you two forces today that come to bear on price that have tremendous power in determining how price is going to move out into the future. The first one is order flow. Now, if you've noticed, that this is the market delta, and I'm going to explain exactly what that is because there may be some of you out there that don't know. If you'll notice that initially there was a big movement towards market profile, and I think if you've seen lately, you haven't really heard much about market profile. We created a really sophisticated market profile here at Right Line, and it just doesn't work. And I don't want to go into the math of it, but there are really good reasons why. It's a tool that I think is going to confound your trading more than it's going to help. The value area high and value area low and point of control are valuable, but they're just not going to help. They have some value, but they're not going to help you trade. Now, this is the volume ladder. And what it shows you is the disparity in the number of traders sitting on the dome on the bid side and on the ask side. And this can work for futures, forex, or stocks. So this can be the disparity in pips, the disparity in ticks, or the disparity this could be a cent level, a pip level, or a tick level. And it's showing you market depth. How many traders are looking to buy the market? How many traders are looking to sell the market? It adds them up and it creates a market delta. In this case, the market delta is 29.85. It's green. So it's telling you that in terms of market depth, there are more traders looking to buy on the dome than there are looking to sell. Now, the problem with the market delta value is we don't know how many of those buyers are serious buyers and how many of those buyers are aggressive buyers. And that makes a big difference. And that's why if you try to use the volume ladder in a way other than the way I'm going to tell you, it's not going to be particularly helpful to you. You can look at bid-ask disparities. You can see this green line, this green dot shows you that there's an increasing disparity towards the buy side. This tells you there's an increasing disparity towards the sell side, and you can look at for redundant disparities on the buy side or the sell side to try to take a trade, but it doesn't have the collective power you need to give you the precision you're gonna want in taking a trade. So we just add this all up and create a market delta value. Now, based on the market delta value, you would assume that there's significant buying pressure here and that this candle is going to close to the upside. But here's the problem with the volume ladder and the market delta value. And that sometimes, this is a positive 222, it's a little blurry, and I apologize for that. Sometimes you're going to get a positive delta with a down candle. And the reason that occurs is because you have some buyers sitting on the dome who are just not particularly interested in buying, so they're way down off price. And you have aggressive sellers who are willing to sell the market for a lower price than it currently is sitting at. So the color of the market delta doesn't necessarily tell you the direction that the candle's going to close. And obviously that's a big problem if you're going to use this volume ladder and this delta value in order to determine how price is going to move out into the future. And the only thing we care about is an indicator's forward-looking ability. We don't care where price has been. We only care where price is going to move out into the future. So that's what we want this to be able to predict. What are we going to do on the right edge of the chart based on this assessment? Now, here's a whole series of candles, and you can see their deltas above them. And you can see this candle had sequential increase in buyers with this green box here. And there's some software systems that actually will use this if you get this sequentially. This doesn't have the power you need. So if you just look at the delta values, you're going to see that the majority of positive deltas are above an up candle, and the majority of negative deltas are on a down candle. So what we have to do is throw out the outliers. But what I want to say again is, if you look at a plot like this, which is showing you a slope of the change in delta, this delta went from 1812 to 2985. The delta got bigger, so the slope of this goes up. This was 222. It's still positive, but it didn't increase in magnitude to this degree, but the line is still going to go higher. Now, it doesn't have any predictive value on the right edge because you don't know if a positive delta is going to be associated with a down candle. So these kinds of plots, which is what you ordinarily see in a market delta indicator, just doesn't have any predictive value in terms of where price is going. So what we have seen is that the majority of delta values do predict. They do have predictive power in this way. The majority of green deltas will be associated with an up candle, and the majority of red deltas or negative deltas will be associated with a down candle. Our job is to throw out the outliers and just use one standard deviation's worth of data, one bell-shaped curved worth of data, and kick out those outliers in the tail of the bell shape. If we can do that, then this value carries significant throw weight. And this is how we do it. We look at the delta of each candle on the two higher time frames. Now, in the trading room, I trade a Unorenko chart. It doesn't matter what you trade. You can trade time, you can trade tick, you can trade any kind of candle you like. The indicator is going to take the two higher time frames. If you trade a 3-minute, it's going to look at the 9-minute and the 27-minute. If you trade a 1-minute, it'll look at the 3-minute and the 9-minute. And it's going to look at the delta values of each of those higher time frames. And if you trade a tick chart, let's say you trade a 56 tick. It's going to look at the 88 tick, and it's going to look at the next higher fib number. So it's just going to keep jumping fib numbers on sequential higher to create those higher time frames. Trading a 5 range, it'll look at the 8 range and the 13 range. Always the higher time frames or the longer term time frames. And it's going to look at the delta value of each of those candles and then put those into a 15-period simple moving average. And when that data is smoothed in this SMA or 15 period, in other words, you're determining the average delta over 15 candles on the longer term time frames. So the outliers where you get a positive delta on a negative delta value or a negative delta on a down candle on a green delta are thrown out because this is smooth data. So when both 15-period SMAs are sloping up, you know the bulls are in control of the market. And when both 15-period SMAs are sloping down, you know the bears are in control of the market and firmly in control, because you're looking at two higher time frames in which the slope of the 15-period simple moving averages must be the same. And when they are not the same, the order flow assessment is going to be yellow. Now, it is a leading indicator and extremely important. Today in the live trading room, I took 2 trades without order flow, and they both stopped me out. We look at a number of independent variables. It's really essential to trade in the direction that order flow tells you to trade. Now, if you look here, you have a move down in price, but order flow assessment is now green. And price is going to turn, and you're only going to be able to trade long. I mean, this assessment is coming off those two 15-period SMAs on the 2 higher time frames. They lead price, and if you try to counter trend trade them, you're going to get run over. You have to trade in their direction. Now, later on, I'll tell you why you can't take a short trade here. Now, I do not recommend that you call a top or a bottom. I think it's pretty impossible to do. But if you do try, and that's in your trading methodology, you can't call a reversal until order flow turns. The problem is I don't believe that you can mathematically determine a high or a low, and so you want to trade with institutional money in the direction of the trend. And really, what is order flow telling us? It's telling us that there's tremendous buying pressure assessed on the 2 higher time frames based on the evaluation of a whole bucket of market delta values. And the only thing that can create this kind of alignment is institutional money. So what we're doing, since we can't look at the flow of institutional money directly, we're creating a marker for institutional money because we want to follow in its footprint. We hear that all the time. It's almost become a catchphrase. We follow in the footprint of institutional money. But this really, really does track moves that can only be driven by big money. Now, here's another trade. Order flow turns first, and you're going to move up. Now, it's great for us that we get counter trend traders. What are they doing? They're looking at oscillator divergence. They're looking at MACD divergence. There's something that's telling them to call a market high and to fade the market, to go short. Maybe they're looking at Elliott wave, and really maybe they're looking at Fibonacci. None of that's going to work anymore because institutional money is going to determine when the market's going to stop going up. And as long as you have this kind of buying pressure, which is significant, you cannot fade the market. Now, these counter trend traders make the move even more likely to succeed because as the move continues up, we're going to stop these traders out. And as they get stopped out, then they're going to buy their contracts back. They sold them to short the market. Now they have to buy them back. Whether it's the Forex, and they have to buy their lots back, or it's stock, and they have to buy their stock back to close their short. It doesn't matter. Counter trend traders against this direction only help, against the order flow direction, only help propel the trade in the direction we want to trade. And here's another example. All green, and the market is almost always going to rise. Not 100% of the time, but an enormously high percentage of the time. Can't tell you exactly, but when you get this kind of buying pressure based off of the higher time frames, remember this is not looking at anything that's going on your charts. This is not green because price is rising. Price is rising because it's green. And that's really different from almost all the other software you see. The other software bases its analysis on data from your trading chart. So when price rises, the oscillator is going to go up. MACD you're going to get a crossover. All the things that are associated with the rise in price are going to happen. This is not looking at any data from your trading chart. That's what makes it an independent variable, and because it's being assessed off the higher time frames, that's what makes it forward-looking. Again, you've got a counter trend trader stuck here, but you've got to trade long. When it's yellow or red, when it's yellow, you just don't trade. And when it's red, you have to trade short. When it's green, you have to trade long. Now, we're not talking at all about an entry. All we're talking about is a directional bias. This sets for you the direction that you must trade. And if one of the problems you have in your trading is you're getting stopped out a lot, the biggest problem with day traders and swing traders is not that they don't get a significant number of winners. I don't think getting a winner is tough. What's really difficult is avoiding losers. And that's what kills day traders and swing traders. You have to trade with a lot of specificity and a lot of precision. And what this allows you to do is to sidestep losers, because you're not going to counter trend trade in the opposite direction of order flow. And it also really does a great job in defining chop for you. When it keeps changing color, price is going to chop. And finally, when the institutions move in to give you that multi-time frame alignment, price is going to rise. Now I want to move to a different deck. And while I'm doing that, I just want to boot my NinjaTrader. So I have that ready. All right, let me move to a different deck here. I'm sorry. Hold on one second. Okay. Now, what I'm going to talk about now is the other force that we use to give us a direction. And we use what's called the Laguerre oscillator. Now, all oscillators are created to assess momentum. And a little bit of background about the oscillator. It was originally invented by a mathematician by the name of George Lane, who's really a brilliant guy. I mean, if you Google him, he did a lot of mathematical work back in the late 50s. Now, if you look at his trading methodology for the ways to, he is the one who created the stochastic formula. So the first oscillator was stochastic. And if you look at the way he wanted to use it, he only wanted to use it to fade the market. Now, stochastic does an assessment of momentum or change in speed of the price of a stock, future, or forex. And because it's a second order derivation, it does have forward-looking ability in and of itself. And I'm going to show you examples of that. I mean, his postulate was that, I mean, to give you an example of what momentum is, and I'm sure everybody has a really good idea. If you have a race car going around a track at 100 miles an hour, and its speed is constant, its momentum is constant. He wanted to look at changes in momentum. So if the race car is beginning to accelerate, momentum is going to rise. And if the race car is going to decelerate, then momentum is going to fall. Now, he believed that change in momentum, which is a change in the rate of change of speed, is going to be a metric that is going to be able to tell you where price is going to move as a forward-looking assessment. So he used it, and I'm going to show you exactly how he used it. He used it to foreshadow reversals. He was only looking at it to assess bullish or bearish divergences. That's the only way he traded it. And I believe that back in the 50s, when he was trading and he made this assessment, he was very accurate. And there's a big difference in the market today from what's going on in the 50s. But let's just take a look. Here is the formula. And there's only a few things that I really want you to note in terms of the percent K line, which is the actual momentum line. C in the formula is the closing price. And you have two 14-period moving averages. One is the average of the 14 previous trading session lows. And the other is the average of the previous 14 session trading highs or candle highs. So he creates a 14-period moving average, one of the average low and one of the average high. And what the formula does, it compares the close to the high. So as the close of a candle approaches the high of the candle, momentum is increasing. And as the close of the candle approaches the low of the candle, momentum is increasing to the downside. Now, here's a little more concrete example. Here, price accelerates up to this point here, and it accelerates up on this much momentum. Then it accelerates up again and forms a double top. But this top has less momentum. I'm sorry, it's going to come up a third time, and this time it's going to come up with lower momentum. So let me explain that a little more clearly. Price accelerates up to here, and with this much momentum, it creates another top and accelerates up with equal momentum. Then when it accelerates up a third time, you can see there's much less momentum. So price acceleration on the third move up was slower. Price moved up here at a pace that was slower than here. This accelerated up fast. This accelerated up just as fast. But price acceleration up to this point was slower. So this race car raced up here to 150 miles an hour, up to 150 miles an hour. Price up here reached this point essentially with a race car that only went 120 miles an hour, not as much momentum. You got divergence, and he believed that that was the precursor to a tremendous drop in price. And you can see that's exactly what happened. After this top, price collapsed. Here's just another example. Price accelerates up to this point on this much momentum. Then it accelerates even higher on the same amount of momentum. You know, when price makes a higher high, you want it to make a higher high on more momentum. You want it to accelerate up 120 miles an hour, come back, accelerate, make a higher high on 150 miles an hour. When they both accelerate up at the same pace, you have oscillator divergence. And you can see that it was the harbinger or the signal that created or told us in advance that price was going to collapse. And that was this inability to create more momentum on this higher rise in price. Now, the other thing that I think was very likely, and this is a very old slide that I took off the internet, was that the oscillator called a lot of trades, although this is not the way George Lane used it. He used it just to trade divergence. When the %K line crossed the 80 line to the downside, you got a short trade. When the %K line crossed the 20 line or the oversold line to the upside, you got a long trade. Now it did it again here. Upside, crossed the 20 line, long trade. Here it went nowhere when the oscillator crossed the 80 line or the overbought line. But here you got a big move when it crossed the 80 line. And here you got a big move, when it crossed above the 20 line. So the oscillator was really good in not only looking for divergence signals and market reversals, but it was also good in tracking a top and a bottom. Now here's the problem, and here's why the oscillator is now really problematic, and most traders use it wrong. This is a much more recent slide, and it says overbought doesn't always mean overbought. And if you day trade, or swing trade, that an oscillator can stay overbought for days, and actually even weeks or months. And even though it can create multiple divergence signals, the market is simply going to continue to rise. And the reason that is because in the last, I'd say, 5 to 10 years, more so in the last five than in any other period, we see that the markets are now dominated by institutional volume. If you trade futures in Forex, they can comprise upwards of 75 to 80% of all volume. And institutional volume is always going to create the trend. And on a mathematical basis, an oscillator going to overbought doesn't matter as long as the institutional money is still pressing the instrument to the upside. So if you're looking to fade the market, it's just not going to happen until the institutional money steps aside. We already looked at one way to assess that, and that's order flow. We know that price is not going to turn until institutional money steps aside and order flow reverses in color. We also know that whatever the oscillator tells us in terms of overbought and oversold, it's not going to matter until institutional money steps aside. That's going to create the high, and that's when price is going to turn. So because of that, although I know there's software out there that tells you can call tops and bottoms, you cannot. And I've discussed this with some really, really brilliant guys. Last week I did a podcast with, I wish I remembered his name. He's such a smart man. And he's been trading for 50 years and absolutely believes that the one thing you cannot do is call a top or a bottom, just like me. So all we can do is trade in the direction of institutional money. Now, I just wanted to say one other thing before I flip this slide. If institutional money now has created such a different trading environment for an oscillator, it's also created a significant trading environment for a lot of other things as well. Japanese candlestick patterns, I think, are important, and I like them. And I've studied them, and I use them. But Japanese rice traders created them based on a very, very important principle that you almost never hear. And the principle is that the power of each buyer is approximately equal to the power of each seller. That's what gives Japanese candlestick patterns such predictive power. That if you get an engulfing candle, or you get a piercing candle, or a dark cloud cover, or you get a doji, because the power of each buyer is equal to the power of each seller, it has real predictive value. But what happens when the institutional traders come in, flip a switch, a computer goes on, and you start getting incredible volume as money pours into the market in the direction the institutional trader wants it to move? It's going to wipe out any Japanese candlestick patterns. It's the same thing for Elliott wave and Gann theory. They believed that there was an intrinsic harmonic present in the market within price. And that intrinsic harmonic is created by the fact that the power of each buyer is approximately equal to the power of each seller. That's why you get that 5-wave Elliott wave pattern. And that's why you get the kind of symmetry that Gann describes. That's all gone now. because the power of all the commercial traders is essentially equal, but the market is dominated by institutional volume. So you can no longer say, and also it's the same thing for Fibonacci. I don't know if Fibonacci ever worked, and I'm not a big Fibonacci fan. But Fibonacci, a level, whether it has value or not, is not going to hold if institutional money is driving price. So I think that you have to change your mindset. And the only thing you can do to become successful is to get in early, right behind this institutional money. You have to track it. And you can't track it with mathematical formulas like Gann theory, Elliott wave, or formations like Japanese candlestick patterns. Even to the extent, at some point, rising and falling triangles. These things are made less valuable by institutional money. Now, in this era of institutional volume, these are some rules that I've developed on how you must trade. And there's no such thing as overbought or oversold. This is a fallacy. I mean, you got to believe me. The market is going to, like I said, will be overbought or oversold and will stay overbought. Like the NASDAQ today just went oversold and stayed oversold for a significant period of the day because big money was driving it down. And if you try to fade the NASDAQ based on divergence, you're going to get run over. And we saw tons of counter-trend traders try to take the NASDAQ long and just get crushed. You can only trade in the direction of the trend. And markets are going to reverse only at the whim of institutional money. When they really do step aside, the market is going to reverse because there's a mathematical reason for that. And that is price always wants to pull back to the mean. There's always a reversion to the mean, and that still applies. In fact, it's still a very strong force in the market. And the further away from mean price, you can use a 50-period moving average. It doesn't matter. I mean, the longer the time period you use, the more power it has because it's a mean price over a longer period of time. We use a 50 period, and price is going to want to snap back to that 50 period stronger if it's been pulled farther away from this mean price. If it's 3 standard deviations away from the mean, it's going to come back with a vengeance. That's the appeal of counter-trend trading. If you really do get into a move where the institutional traders have stepped aside, you can take this move that's way, way up and ride it all the way back to the 50. The problem is you just can never know when the institutional traders have stepped aside. Sometimes they take a breath, the market will come down 2 or 3 candles, volume will drop off, then they come right back in and blow it down, another $1.50 or another 50 or 60 pips or 50 or 60 ticks. So trading divergence is tantamount to trading against the flow of institutional money. And you can only trade in the direction of institutional money. Order flow is one way of doing it. And I'm going to show you another way now. The indicator that most accurately assesses buying and selling pressure, completely ignoring any potential divergence signal, is the Laguerre Oscillator. Now, the Laguerre was not created to look for divergence. The stochastic relative strength, Williams percent K, and all the other variations of oscillators were all meant to look for divergence. The Laguerre was meant to track the direction of momentum. It has a default gamma of 0.5, which we have changed. because the gamma defines the speed with which that percent K moves. And then it's got filters that define its stability. So we've modified it, the Laguerre. It doesn't have the classic default settings. And what we've done is we've looked to create stability, but also still have speed in tracking the direction of momentum. Because what we want to do is trade in the direction of multi-time frame of momentum. And you'll see what we do with the Laguerre is exactly the opposite of what you may have been taught. Now, this is just a Laguerre which is on your trading chart. It is not a multi-time frame assessment. I'm going to show you the multi-time frame assessment on a live chart. But we look at the direction of the Laguerre on our chart and the direction of the multi-time frame assessment. We want the Laguerre on our chart to move in the direction of the multi-time frame. But when the Laguerre starts to move up, crosses the 20 line, and then crosses the 80 line, we consider this a lock long. Now, the only thing that can lock the Laguerre long is institutional money. Commercial traders like you and I cannot lock this Laguerre long like this. We don't have the money. And once you get that lock, here's your entry. On the cross of the Laguerre line, this magenta line above the 20. And here's the lock. Now, if you're looking for divergence, you're not going to get it. At least this indicator is not looking for divergence. And if you try to trade divergence anywhere here, you're going to get stopped out. Now you can exit on this arrow, and then you get another lock. And you're going to trade this instrument long. This is a 30-minute of the Qs. And it's demonstrated better here. And I wrote, I like the 60-minute chart best. This is a better demonstration. Right there is the Laguerre short arrow. It's where the Laguerre crosses the 80 line to the downside. You can take the entry here, but this is our 15-period exponential moving average. Got to wait for it to break. Again, though, we're just looking at the direction you must trade. Once the Laguerre locks short, this is institutional money at play. And the 60-minute of the Qs price is simply going to fall. This is just the trading chart Laguerre. I've not shown you the multi-time frame Laguerre, which even has more power than this does. Same thing. Cross above the 20 line. This is going to flash intra-candle, give you an opportunity to take the signal when the candle prints. You're going to get this long trade, and once it locks long, you're sitting pretty. Because when institutional money locks the Laguerre long, you've got yourself a nice long trade. Now, it falls right below the 80 line, right here, which could be your exit. Now, this is a daily chart, so you've got a nice amount of profit here. Here are futures. There's the cross of the 80 line down, the lock, short, and the move down. Now, one other rule that we have is we only trade short below the 50 and long above the 50. And on a move to the downside, we want our 15 exponential to be below our 50. Here's another trade short. There's the entry. There's the lock. There's the exit. Now, I just wanted to give you one comparison. I have slides where there are multiple comparisons. But it's so complicated, I didn't include it. But there's your Laguerre entry right here on this arrow. And here is the oscillator or stochastic entry. It gets you into the trade 2 candles earlier. But here's the problem. The stochastic oscillator is looking for divergence. So it shoots right above the 20 line. and you have to exit the trade because you have a cross of the percent K line with the signal line, and it's right at the 20 line. So you get taken out of the trade right here. But the Laguerre is geared to do just the opposite. It's used to assess momentum, and you can see, even though you get one green here, two greens here, a green here, and a green here, you get the lockdown, and it stays locked down. And the lockdown means the Laguerre line is below the 20 line. When it's plastered down, it's at 0. But as long as it stays below there, you're going to get this red line. And you're going to let these counter trend traders help the move down. Every time they buy and try to turn the market against the direction of institutional money, they're going to get stopped out. Stopped out here, stopped out here, stopped out here. 4 times. Now, eventually, they're going to call it right. But how many times can you be wrong and still have any money in your trading account before you eventually call a bottom? It's something that you just can't do. Now, there's 2 kinds of entries, and I'm going to go into that when we get to our trading chart. And so what I'm going to do is I'm going to drop this, and I'm going to actually drop this. And let me just give me 1 second, and I'm going to put up our chart. Now, I will put up, if you want, I'll put up initially a chart of crude oil, but we can put up a chart of anything. And here's crude today. Now, we have our own proprietary candles. They're called hybrid Unarenko, which you get as part of the system. And all I'm going to do is load the template. Right here. And then I'll explain what you're going to see. So here's what you're going to see. The top line here is order flow. The middle line here is the multi-time frame assessment of the Laguerre. The lower line is the assessment of the Laguerre on our chart. Now, the only thing I want to do is make sure that the setting in here is right, and it is correct. So let's take a look at, now here's what we're going to do. I wanted to show this to you, and then I want to remove it. I want to make the chart as easy for you to read as possible. And the way to do that is to project the order flow results on the candle halo. So when order flow is red, the candle halo, I've just decided to make my candle halo magenta. When order flow is green, is up, it's going to be royal blue. So that you don't have to look at this line. It's superfluous because you can see it mimics exactly the candle halo. So since we get the data on the candle halo, I'm going to make order flow, the line, going to make it transparent and take it off the chart. And I'm going to put it, same as input series, and change the inputs. Now it becomes a lot easier to read. And what you want to do is you want the Laguerre on your chart to move in the direction, the same direction as your long-term Laguerre, and be haloed in magenta for a down move, or haloed in blue, royal blue, for an up move. Now there's one more thing that I want to go through quickly, and those are pivots. Now the pivot indicator is included for the first 10 purchasers. We have a lot of traders in the room. Most software does pivots wrong. Our pivot indicator is extremely important. Pivots are created not at a wick low or a wick high, but at a candle body low and a candle body high. That's our audible alert. So this is where the pivot should be. And this is where most software tracks it. So hold on, let me turn the sound off. That's where most software is going to put it. And it's putting it in the wrong place. And you can see when price comes down to it here, it bounces. Comes down to it here and bounces. Comes down to it here and bounces. Now if the pivot was all the way down here, you might assume that you have room. But this is a correct pivot. In addition, a pivot's only broken by a 2/3 candle body close below. So this is the breaker that breaks the pivot. 99% of pivot indicators will break when one tick or pip or cent traverses the pivot and prints. That is wrong. If you want to stop all these buyers out, you have to have a 2/3 candle body close below. And this is a trade for us right here. Why? We break the pivot. It's called the pivot breaker. And now I'm going to have a webinar for all of you that purchase, and I'm going to show you all the different trade configurations. There are 2 or 3, but they're very simple. You can see the candle is haloed in magenta, so you know you have the multi-time frame assessment of order flow. You can see the long-term Laguerre is red, which is extremely important. You want long-term momentum to be in your direction. It's right here. And the Laguerre on your chart is sloping down. If you move, I move it right there. So momentum on your chart is heading down. And you're good to go. And this is a really nice short trade. And I can show you a whole bunch. I mean, you're going to get a million trades. Here, you don't have order flow. So you have to wait for the first pullback, which is this wick. You're in on the pullback, and you've got everything. You've got order flow, multi-time frame, and both Laguerres are locked short, and you get this whole move. If you're out on this up candle, because we exit on a reversal candle, you don't have to despair, because this long candle is haloed in down order flow, which means it's going nowhere. The traders in this are counter trend trading this against the direction of order flow. The vast majority of the time, you're going to get the short roll. We're going to run these traders over, and we're going to get a further move to the downside. And I mean, we can go over these trades forever. There's your break. There's your winner. Dual Laguerres. Order flow, break of the pivot. Now here's your break. It's not a big move. Here's your break. This is a small move. Now, you would have an entry here on this arrow, but you don't, because you don't have the long-term Laguerre. In fact, you don't have a trade here at all. See this upper line? Doesn't go red. In fact, you don't have a trade here either. You don't have that trade. You just have this trade and this trade. Because this upper line has got to be red, and the candle's got to be haloed in magenta, and you need your Laguerre the chart Laguerre moving in the direction of the long-term Laguerre. And if you look at that, you're going to find that it's very rarely going to set up for you in chop. I'm just look at this move up. And I'm not cherry picking these, believe me. Now look how order flow saves you from that trade. You've got dual Laguerres locked long right here. I hope I'm not confusing you. So I'm going to stop in about 1 second and take questions. Because this is the same. You're going to get this on any instrument you trade. Doesn't matter the time frame. It doesn't matter whether it's Forex or stocks. You can trade a 4-hour candle. You can trade a 2-hour. You can trade a daily. It's irrelevant. This is a time frame independent. These are time frame independent forces. And it does not make any difference what you trade. Order flow here is aligned to the downside. So this trade is doomed and you're not in it. Now order flow here is also aligned to the downside and you can't take it. You have to get a pullback and there is none. See how there's no wicks here? So it keeps you out of the winner, but it saves you from taking the loser. And that's what we want to avoid. You're going to lose more money on the loser probably than you will make on the winner. And let's just, I mean, there's another winner. Here's the break and another winner. Here's the break. It's a short trade. I'm just trying to look for a trade that fails, and you're rarely going to get them. This is a terrific trade right here. You have order flow, long-term Laguerre, short Laguerres heading in your direction, and you have this entire move. And this trade was on 5-1. It was yesterday. And it was at 1024. Huge move down. No pivots holding it up. So that's as in depth as I'm going to go here. If you come aboard and you purchase the system, you get everything that you see: the order flow, dual Laguerres, the pivots, the configuration. We do all the templates, the whole setup for you. You don't have to worry about any of that. Plus, I'm going to put you in a webinar that I'm going to do next week. I'm going to show you all the intricacies and all the ways you can take a trade. Like here's a great trade. See the wick pulls back to support, and you have the continuation. Because you have dual Laguerres locked long, you have order flow, and you have a nice long trade. And it's a rare loser as long as you adhere to these rules. 50 green, 15 green, 15's above the 50, 50's heading up. And boom, there you go. So let me just show you the offer and then I'll answer any questions. I don't have much time for questions. I'll just take questions for a couple of minutes. Hang on 1 second. It's here. Let me put the slides back up. Now here's the offer. Now, normally the system's is $19.99. The special offer is $6.99 for a lifetime license. You get free upgrades for life, and we are always trying to make the system better. You get a month in the live trading room with me. You get a 10-module educational training series, and you get our video tutorial library, which has 450 videos. And the first 10 orders get the pivot indicator, which is $2.99. And it's one of the rare pivot indicators that actually works. We get a lot of people who request the pivot indicator as a standalone indicator, and we don't give it out because it actually traces pivots where they should be, and they have tremendous power. When you snap a pivot, price rockets off of it. and the offer expires Sunday. Our number 786. This is the wrong number. Let me just get that on there really fast. I'm sorry. We just changed it. I can't really change it on here. I'll tell you what it is. If it's 786, it's 732-4656. 732-4656. Let me just quickly answer a couple of questions, then I'm going to turn it over to Marie. Okay. I'm going to try to do this really quickly because I don't want to run over. Hang on one second. Okay. Hey guys. Hey, Oswald. No, I do, Oswald. Yeah, risk and money management are essential, Oswald, for sure. Okay. Well, that's something that we're thinking about, Oswald. Okay, let me just keep going here. Hold on one second. Hold on. Okay, Linda. It works on any future, Linda. You just saw that I put it on. I put it on crude oil. It works on all. Like I said, it is instrument independent. It is time independent. It'll work on any market, on any financial instrument. Again, on any time frame. What are the settings for the SMA lines? It's just a simple 15-period SMA. That's all. It's not a sophisticated SMA. That's all. It's a 15-period. I don't have time for it because it's 2:02, Mike. If you want us to show it to you, you just call the office. We'll put it up for you. I mean, today on the E-mini, it was like a house on fire. It gave you 4 winners and no losers. The NASDAQ is without a doubt the toughest market. It is the beast, and you really have to be ultra conservative. But it's fabulous on crude. It is great on the E-mini, and is really good on the NQ. You just have to be very careful with the NQ. I don't have time for that today, Stephen. What platforms is Moaz, it's only on NinjaTrader 7 and NinjaTrader 8. But if you want, you can run a demo of NinjaTrader 7 or NinjaTrader 8 off your TradeStation data feed. We have an API, and you can take the trades off of Ninja on TradeStation. So you can run this for free. It won't cost you anything. And the data feed you use, we bring over from Thinkorswim. And we configure that for you. So it'll run everything, and it won't cost you a penny. Listen, Dale, all of the indicators are doing their assessment intra-candle. So the one that's the toughest to get it's a great point to wrap your hands around is going to be order flow. Because in the middle, as the candle matures, it may be against you. The order flow may be against you. Then towards the end, it may be in your favor. It's just something you just have to watch very carefully. I mean, that's why every now and then you may get caught in the wrong direction. But the assessment's not complete until the candle's done, closes and prints, and the ultimate color is what it's surrounded with. But you're correct. You've got to watch because intra-candle, the order flow line is the one that's the most. It's called labile, is the one that changes the most. Somebody else brought up because those 15 periods could be an inflection point and keep changing the color of the candle. You just have to follow it carefully. That's all. That's all you can do. You don't want an end of candle assessment. You want to see how the candle matures. NT7 or NT8. It's not on TradeStation, Wes. Okay, guys, listen. Thank you so much. And I thank Traders Corner for having me. If you have any other additional questions, you can send us an email or send us or give us a call. Again, our number is 786-732-4656. And if anything, at least I hope you may have learned something about our trading methodology and what I believe is going to be valuable for you. So have a wonderful, wonderful afternoon, and thank you so much for giving me your time. Take care and have a great day.